Welcome to Accounting 100 Practicum Week 5, Sales and Invoices. Once we have our sales team in place and we have our product ready to go, we can start selling. Sales documents are necessary business forms required to record revenue earned by our company and to track the amount due from our customers. The types of sales documents we will use depends on our type of business or industry. We had a good discussion of service versus merchandising companies in Chapter 5 of our textbook. I encourage you to go back to the textbook and reread this section. The two basic types of sales invoices are product invoices and service invoices. So if you have a merchandising company that sells products, you would choose the product invoice. If you provide a service or charge professional fees for your services, you would use the service type of invoice. Other sales documents are sales receipts and statements sent to the customers on a monthly basis. When merchandising firms record the sales of their products or merchandise, they use a sales account. When the invoice is prepared, the sales account is credited. Invoices are typically prepared in multiple copies to serve as evidence of the sales transaction. These copies can be sent to the sales department, the accounting department, the credit department, and also to the customer. Let's take a moment to review this product invoice. This is an example that we are continuing with our company, Clothes for a Cause. And this is showing a sale the company made to the Target Corporation. This form may look familiar to you as it is generated from QuickBooks accounting software. It can also be customized to have the appearance desired by the company, including the company's logo. You may want to click back to the invoice example on the previous slide as we discuss each of these details. First, you will see a space for the customer billing and shipping addresses. Next, you'll see the customer purchase order number that would correspond to the purchase order used when the order was made. You may also have terms for this customer. For example, 1% net 30 would allow the customer to take a 1% discount if they pay the invoice balance within 10 days. Your invoice might also include the sales representative who gets credit for this sale. The shipping date and shipping method are also usually notated on the invoice. Here's an example of a customer statement. You can pause the PowerPoint to review this statement. The statements are usually prepared for credit customers and then mailed to them on a monthly basis. They include all of the amounts still due from previous invoices that represent the purchases the customer has made. Statements can also show more details, such as the payments that the customer has made, and they're shown as a deduction from the amount due. At the bottom of our example statement, you can see a breakdown of the number of days the amounts are past due. This customer, Target, has a past due amount of $5,000 that's been due for more than 90 days. You may want to consider not allowing any more sales to Target until their account is current. The customer can use a remittance copy of the statement. They can write the amount they enclose in the space provided and then include that copy with their payment. You can go back to the statement to observe each of these details we described. Of course, some customers return all or part of their purchase. This is called a sales return or sales allowance. We use the sales returns and allowance account to handle this transaction. It is considered a contra account. In other words, it is the opposite of a sale. So this account would reduce the total amount of sales revenue. When a return is made, a credit memo is issued to the customer. It is a written statement that indicates that the seller is willing to reduce the amount of the customer or the buyer's debt. This would show on the statement as a reduction of the amount due. Depending on the city, the state, or tribal nation where the sale occurs, the seller is required to levy a sales tax on all sales made. The sales tax is charged to the customer and recorded at the time of the sale. This sale is recorded in the sales tax payable account and will be remitted to the taxing authority on the date that it is due. So the customer will owe the total amount of the item purchased plus the applicable sales tax. We mentioned earlier that the sales account is credited at the time of the sale. The debit would go to accounts receivable, an asset account. An accounts receivable ledger is also maintained for each individual customer. The ledger lists all the credit customers, the details of the sales made to these customers, and their current balance. So, it's necessary when you post the accounts receivable that you also post to this subsidiary ledger, also known as the accounts receivable ledger. You keep a summary of all of these receivables on an accounts receivable schedule. This can be done with your accounting software, or you can keep it manually. In this case of close for a cause, you can see the balance due from Target at December 31st, 2018 is $5,450. In addition to Target, Close for a Cause has other credit customers, and their balances are listed here. The total receivables at December 31st, 2018 are $9,000. This is the amount you would see for accounts receivable on the balance sheet. Using the information in this PowerPoint, you can now create your own invoices for your customers. Go back to the module and open the Practicum Week 5 assignment.